Howdy, y'all. Welcome to Liberty Call. Today is Wednesday, September 6th, 2023. Hope everybody's having a fantastical day out there in the interwebs. You can see my boy Jake back here. Super excited about the markets because they suck again today. But again, not really unexpected that the markets would take a turn. Didn't think it'd take this long for it to start to slow down, but maybe all the things the Fed has been doing to help us out, and I put help in quotes, maybe it's helping. I don't know. Granted, I thought we were going to go through this downturn 3 years ago, but I wasn't really expecting the Fed and the government to print $5 or $6 trillion and, cover up the problem for a couple of years. But now we're going to have to deal with it again. And, we'll see what the Fed does. Are they going to come right to the rescue like the Lone Ranger, woohoo, and, save us again with, zero interest rates and money printing and, make things feel good at the moment. It's kind of like heroin, you shoot that needle, you feel good for, an hour or two. I don't know. I don't use heroin, but I took morphine once last year when I was at the hospital. It made you feel good for, an hour or two. I was like, whoa. Anyways. All right. Well, like I said, this is Liberty Call. I'm glad you're here. Thank you very much. If it's your first time, if you could give me some thumbs up, likes, shares, subscribes, follows, hit the notification bell so you know when we go live. And let's go ahead and jump into the numbers for today. They're not very good. Let's see here. Dow Jones was down 0.57%, 198 points, closed at 34,443. S&P 500 was down 0.7%, closed at 4465. NASDAQ down 1.06%, closed at 13,872. The VIX was up 3.28% today. It's at 1447. Canada was down 0.92, Brazil down 1.06, and Mexico was flat at up 0.06%. In Western Europe, Germany was down 0.19, the UK was down 0.16, France was down 0.84, Netherlands was down 0.22, Spain was down 0.83%, Italy down 1.54%, Switzerland down 0.31%, and Portugal down 1.08%. Russian exchanges both in the red, the MOEX down 0.58, the RTSI down 1.18. And the overnight's a little better. The Nikkei in Japan was up 0.8%. Australia down 0.78. New Zealand down 0.58. In China, the Shanghai was up 0.12%. The Shenzhen Component down 0.24. China A50 down 0.15. DJ Shanghai up 0.06. Hang Seng up 0.03. So those are basically flat. And the Taiwan weighted was down 0.32% for the day. So again, like I said, I wholeheartedly expect us to go through some major, downturn, bear market, whatever you want to call it, recession. But, again, my main fear is that the Fed's going to come and try to help us out with a bunch of money printing, which, again, will solve the problem short term, maybe. But I just don't see it being a long-term solution, and it's going to put us further behind the eight ball. All right, today's market recap. Wall Street slides as economic data stokes inflation worries and Apple drags. On Wednesday, Wall Street saw a decline in stock prices influenced by stronger than expected services sector data that heightened concern about persistent inflation and the likelihood of higher interest rates for an extended period. Additionally, a slump in Apple shares further weighed down on the market. The ISM, the Institute for Supply Management, ISM, reported that its non-manufacturing purchasing managers index rose to 54.5, surpassing expectations of 52.5. This data also indicated an increase in the prices paid by service sector businesses for inputs. This news led to a shift in traders' expectations regarding the Federal Reserve's actions. Prior to the data release, there were expectations of a pause in the interest rate hikes in both September and November. However, following the data, bets on a pause in November fell to 46.8 from nearly 57%, according to the CME FedWatch tool. Investors had been hoping for interest rate cuts in the near future. Again, I've been telling you this. They've been hoping and hoping and hoping. It's not happening. And I think that's eventually, I think business has been just holding on, for dear life, waiting for the Fed to lower rates. It's not going to happen. And I think that's going to be the catalyst for, the economy, falling on its face here in the near future. Where were we? The ISM services data suggests a robust economy with inflation that is not subsiding quickly, which means the Fed might not cut rates anytime soon. Boston Fed President Susan Collins emphasized the need for a cautious approach to the central bank's next monetary policy steps. In terms of sectors, technology stocks were the hardest hit with a 1.6% decline. The only sector to see gains was defense utilities, which rose by only 0.1%. Apple shares fell 3.7% following the report that China had banned central government agencies from using iPhones and other foreign-branded devices for work. Other major tech companies, including Tesla, Amazon, and Nvidia, also saw declines ranging from 1.6% to 3.8%. The market also had a muted reaction to the Fed's Beige book snapshot of the U.S. economy, which showed modest economic growth and subdued job growth, along with some easing of inflation in most regions of the country. Concerns about persistent inflationary pressures, as well as the possibility of the Federal Reserve maintaining its hawkish stance on interest rates, have been amplified by recent increase in oil prices. Lockheed Martin shares dropped by 4.5% after the defense contractor trims its delivery outlook for its F-35 jets. They're still making those things? I thought they were junk from the beginning, but, I haven't read any positive articles about it. And the only reason I have an interest in it is because I used to work on Navy jets back 30 years ago. On a positive note, Roku rose 1.9% after announcing plans to reduce its workforce by about 10% and limiting new hiring. Overall, declining stocks outnumbered advancers on both the New York Stock Exchange and NASDAQ exchanges, underscoring the day's bearish sentiment. Again, not good. So, all right, next up, let's dive in a little deeper on the Beige book. This comes from Zero Hedge. It's titled Ominous Beige Book Warns Consumers Exhaust Savings as Recession Mentions Soar to 5-year High. And this was, Tyler Durden. I know that's a pseudonym or a alias. All righty, diving in. The latest Federal Reserve Beige book released recently painted a mixed picture of the U.S. economy with modest, and that's in quotes, growth being a common theme across various sectors. Here are some notable takeaways. Number one, consumer spending divergence. The report highlighted a divergence in consumer spending while spending on tourism exceeded expectations and surged as people indulged in leisure travel post-pandemic. Spending on non-essential items continued to slow. Importantly, the report indicated that some consumers may have depleted their savings and started relying more on borrowing to sustain their spending. Auto sales and manufacturing. Number two, new auto sales expanded in many districts, although this was attributed more to improved inventory availability rather than a surge in consumer demand. Manufacturing contacts reported better supply chain conditions, enabling them to meet existing orders, but new orders remained stable or declined. Housing market challenges. The inventory of homes for sale remained limited in nearly all districts, with single-family housing in high demand. However, construction for affordable housing units faced challenges due to rising financing costs and insurance premiums. Labor markets. Job growth was described as subdued across the nation, with labor market imbalances persisting. The availability of skilled workers and the number of job applicants continued to be constrained. While worker retention improved in some sectors like manufacturing and transportation, wage growth was expected to slow in the near term. Number five, price pressure and profit margins. More districts reported a slowdown in price growth, particularly in manufacturing and consumer goods sectors. However, some districts noted sharp increases in property insurance costs. Input prices grew faster than selling prices in several districts, leading to a decline in profit margins. Number six, overall economic activity. Economic conditions were generally described as stable or slightly growing in many districts. The availability of labor and labor costs remained key concerns, while consumer and business spending varied across regions. Construction and real estate activities were mixed, and inflationary pressures varied across sectors. Recession mentions. The report noted an increase in mentions of the word recession compared to previous periods, with some reports suggesting that a recession could be looming. Dun, dun, dun. The elevated level of recession mentions is noteworthy, considering it was relatively rare in the Beige Book reports in 2020 and 2021. In summary, the Beige Book signaled modest economic growth, but revealed underlying challenges in consumer spending, labor markets, and housing. Rising price pressures and concerns about profit margins were also evident. The increase in recession mentions may reflect growing uncertainty about the economic outlook, warranting continued vigilance from the Federal Reserve. Because if the Federal Reserve isn't anything, is vigilant. I'd say they're more like idiots, but that's just my own personal opinion. All right, one last article here. It's also from Zero Hedge. It's titled Peter Schiff, Fed isn't making any progress against inflation. And this is a breakdown of his interview on Fox News Digital. So we're going to go through what the highlights of that. All right. In a recent interview on Fox Digital, economist Peter Schiff delivered a sobering assessment of the Federal Reserve's battle against inflation, dispelling the notion that the central bank is making any progress in this fight. Schiff began pointing out that the Bureau of Labor Statistics, the BLS, had revised down the non-farm payroll numbers for all 7 months of the year, suggesting a bias in the BLS assumptions and stronger labor market than portrayed. While unemployment has increased, average hourly earnings have risen less than expected, a concern given the continued rise in prices. He highlighted a spike in spending, but only a marginal gain in incomes, leading consumers to dip into their savings. The savings rate plummeted to 3.5%, indicating that consumers are struggling despite a depleted rainy day fund. Schiff argues that the Fed's rate hikes intended to reduce spending and boost savings to combat inflation have not been effective. Instead, consumers keep spending, undermining the central bank's efforts. The situation, according to Schiff, constitutes stagflation with a weakened economy and labor market, but strengthening consumer prices. He noted that the headline CPI, Consumer Price Index, may have bottomed out with little reduction in core CPI. Despite the Fed's efforts of achieving its 2% inflation target, it seems elusive. Meanwhile, federal budget deficits continue to grow with government spending on the rise. Schiff advocated for a combination of the Fed raising rates and the federal government cutting spending as the proper response. However, political realities makes significant spending cuts unlikely. Yeah, no one wants to be the person to cut Social Security, Medicaid, Medicare, all those freebies that me and my wife and taxpayers pay for, but the parasites, they're the ones who get upset and won't vote blue the next time. All right, and to finish up, Schiff cautioned that even if there is another quarter-point rate hike in September, it won't be sufficient. Much higher interest rates are needed to effectively combat inflation, but the U.S. economy can't afford them. Such rates would not only induce a recession, but also trigger a financial crisis more severe than the 2008 financial meltdown. In summary, Peter Schiff's assessment suggests that the Fed is facing an uphill battle in taming inflation, with the risk of economic and financial turmoil looming large. The prevailing optimism in the markets regarding inflation may not be well-founded, given the underlying challenges the economy is grappling with. And there's also a video here if you want to watch it. So just go to the show notes. It is the last article attached, and you can go ahead and watch that if you want. Peter's, I listen to his podcast. He puts it out a couple times a week. He's usually pretty good on stuff. He's a bit of a gold bug. In his mind, gold solves all problems. And I do think, I am a fan of gold. It's a means of stabilizing currencies and things like that. But it's not the be all end of all solutions. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening. I'm going to go hang out with my dog, Jake, here. We're going to go throw the ball out there in just a minute. Y'all have a wonderful evening. I'll talk to you next time. Adios. There we go.